Hello friends, got a trading strategy video for you, this one being supply and demand zones, so let's just get into it. So an essential part to trading this strategy is obviously identifying where the supply and demand zones are. But in order to do that, you kind of have to know what they are in the first place. And zones really just refer to areas of strong buying or selling liquidity. And that usually lines up with these large impulses. So as you can see right here, we have this area, this zone, and a large impulse that follows. And you also have this zone where a large selling pressure follows. And all that signals to you is that there is a lot of buying pressure, a lot of buying liquidity here that led to that impulse, and a lot of selling liquidity here that led to this impulse. And when you have these large impulses, that often means that orders that contributed to the impulse are left over there. So if price returns back to those zones, it goes up, retraces, goes down, retraces, you can assume that there are some leftover orders there that price will be met with that will lead to a continuation of that previous uptrend or that previous downtrend. So if price returns to those levels, you would basically be banking on leftover orders, leftover liquidity, continuing that trend. So if you're able to find the pools of orders, the liquidity that led to these impulses, you can find the zones. And here are some examples, or here's an example. So we have this area right here, consolidation, and then this large impulse that left a lot of imbalance in the market. So we formed this high, and we retraced back to the zone where we were met with these leftover buy orders that led to another impulse to a new high. So you have this pool of liquidity, of buying liquidity that was left over from this large impulse because it happened so quickly. Price returns, gets met with that leftover buying liquidity, and then continues to a new high, busting through the previous one. And here is another example. So again, we have, can't see because the picture's cut off, but consolidation, a low that led to a large impulse to a high. Price retraced, came back into that zone, was met with the leftover buying liquidity, quickly reacted, and led to a new high. And here is a sell side example. So we have this high up here, retrace a little bit, consolidate, sort of, if you want to call this consolidation, and it led to an impulse down. We made a low, and we come all the way back into that level, this zone, where we're met with leftover selling liquidity. Leftover sell orders that put selling pressure down, push it to a new low, breaking through this previous one. So just to recap, zones are just areas of liquidity. They're areas where lots of buy orders or sell orders enter the market. And you can identify those by previous impulses that signal to you there's a good chance there's a lot of leftover liquidity in those areas where the initial impulse started. So now let's talk about how you actually draw supply and demand zones, because this can be very subjective and there is no one size fits all. It really depends on context, your preference, and really anything. It's all subjective. Keep that in mind. But there are some basic ways that you can draw your supply and demand zones. You have single candle body, which is just the candle body, literally just the single candle from its close, body close to its body high, and then a single candle wick to wick, an order block, or a range. Now, other people might say there's other ways, but it doesn't really matter. These are the main ways, and I'll go into each one, starting with the single candle body. So as the name would suggest, it's literally just a candle body. So we have this impulse right here, and the candle that preceded that impulse, often red, doesn't have to be, could be a green candle, but the candle that preceded this impulse up that led to the high, that is the candle body that most people would focus on if they're using the candle body approach. And as you can see, price came back down into that level and then made a new high. Now here is the candle wick to wick. Same chart. You just take the previous candle, the top, the wick, which is in this case almost the same as the body, but that's not always the case. Take the top of that wick to the bottom of the wick. And still applies, same price action, doesn't matter. But the purpose of this is this would be your invalidation level. So any price that falls in here would still be valid in terms of reacting to this demand zone. Now, in this particular instance, it didn't really matter because price never went below that candle body, but sometimes it does. So this is why it really depends. You want to be flexible with how you draw your zones, because sometimes they apply different ways, different times. And my favorite is probably this one right here, the order block. So an order block, a lot of people maybe have different definitions, but for the purpose of this video, this will be my definition. It really just means the sell candle or the series of sell candles that lead to the buy. So as you can see, we have 2 sell candles in a row before the impulse higher. And if this was a supply zone, it would be the buy candles that lead to the sell candles, but it's the same thing. It's just the series of buying or sell candles right before the impulse. So we have it at the wick of that first sell candle to the bottom wick of the last, in this case just the second, the last sell candle, and that is your zone. And the wider your zone is, the more reliable it would be, because if you have just the candle body, it's obviously a very small area, and if you're basing your stop off the bottom of that candle, you could get stopped out pretty frequently, even if the trade in general goes in your direction or is consistent with this lower invalidation level. And that brings us to the final one, which is a range zone. Now, this is similar to the order block, and oftentimes it can be the same as an order block range, but it is different. This isn't the best example, but you'll still get an idea. So the range is exactly what it sounds like. It's just the range of where price was consolidating, the whole entire zone. So we have this wick right here, and then this wick right here. That is the demand range, the demand zone where price comes in and bounces off of. And again, I just want to reiterate, you can use these however you see fit. Sometimes people use them at different times because they apply at different times. Price is flexible. There is no one rule. It doesn't follow a particular zone drawing strategy. And that's why sometimes it's best to use them together. So this is the range in addition to the body. Now you can use that however you want. This could add layers to your conviction. This is just the general zone you maybe look out for, and then you wait for price to get into this higher conviction body zone. It's up to you, but don't feel like you have to commit to one way of drawing your zones. Sometimes it is helpful or beneficial to use multiple zones just to add different layers of conviction or context to your trade ideas. All right, now let's transition to structure, because this is a very important element to supply and demand that a lot of people overlook. So whenever you're looking to draw supply and demand zones or trade a supply and demand strategy, you want to be asking yourself, is price in a structural uptrend? Is it in a structural downtrend, or is it trading sideways? Because that will have different implications for how you position yourself. If price is trading in an uptrend, you're going to have a bullish bias, and you're going to be looking for retracements into demand zones. Conversely, if price is in a downtrend, you're going to have a bearish bias. You're going to be looking for price to retrace into supply zones. And if price is trading sideways, that may not be giving you any really reliable opportunities for demand or supply zone trades. So you want to always have that in the back of your mind. You want to have your demand zones, your supply zones in context, and view that through the lens of structure. So here is an example of what I mean. So we have this high right up here, and we make a low, we make a higher high, and then we break that structure. So we break through this low. And when that happens, you can assume that you're going to make another lower high, because you're now shifting the structural trend. You're no longer maintaining this high, low, higher low structure. You make this lower low, and then you are presumably, if you're going to continue this now broken structure that is a downtrend, you're going to make a lower high. So once you identify that structure, you want to look for what supply or demand zones apply to it. Now, I'm not sure why this supply zone is green, but you get the picture. So we break through this structure right here, make a lower low. So as soon as you see that, you'll be looking for a lower high, at least lower than this previous high, because we are now in a structural downtrend. So where is the supply zone? Now you could base it off of this. This is kind of like a zone shift, but you identify this supply zone pretty clear. It's kind of an order block right here, and you come back into it, and then you make a new lower low. But that is based off of this break of structure, because you're making these highs, this low, higher high. And as soon as you see this, you don't want to be bullish because you have broken structure. You want to be bearish. You're looking for sells to continue this now downtrend structure. And here is another example. So we have this clear uptrend with a series of highs, higher lows, higher highs, higher lows, higher highs, etc. We make a low, make a high, and then we break structure. We break these lows, and now we are looking for bearish. And if you're not bearish trades, sell side trades, and if you're not convinced that this is a break of structure, it doesn't really matter. You can sit out and wait for that lower high to be put in. And if you were going to take this trade, again, you want to be looking for where is the relevant supply and demand zone that would be consistent with that new structure, that lower high structure. And now you could base it off of this order block with this green candle that led to this high, and that's exactly what happened. It traded just perfectly into there, and then it made another lower low. And at this point, you can be pretty confident that the structure is undeniably in a downtrend. So we made a high, we made a low, break a structure, made another lower high consistent with that new bearish downtrend structure, and made another lower low. So now we're convinced we are in a downtrend, and we will be looking for another lower high based off of the previous one. So just like this, where you could have based your supply zone off of this order block from this candle to this high, you can do the same thing from this candle, this large green candle, to its high that led to this lower low. And what did price do? It retraced into this order block supply zone and then went right back down to make a lower low. And the target is usually, if you're consistent with structure, where that lower low was, entry at the zone, invalidation at or just above where that high would be. Because if you break above that high, that's a break of structure. So you're banking on structure continuing. And then here's one more example. This chart might be a little messy, but hopefully it'll help. So we have a high right here. We're in a downtrend, and we come up to make a lower high, and then we come back down to make a lower low. So we're now looking for another lower high that doesn't trade higher than this level right here. Now this supply zone is kind of an order block. You could also call it a range, but it's from the low point of these buy candles to the high point that eventually led to the sell-off. And what happened? You have this high to low, and price comes right back in to this area supply, consistent with the structure, making a lower high. And I took this picture before price actually went all the way down, but it did eventually trade to a lower low. So it was consistent with structure, because your take profit would be right below that previous low, because you're continuing the structure to presumably make a lower low. And now before I move on, I just alluded to this earlier, but one thing I really want to mention is zone shifts, because this is very common in supply and demand zones, because you have a high right here, and then you retrace, and you have a little consolidation that leads to a zone shift. And what that means is, rather than the zone really being based off the high, because you'd call it maybe this candle wick to that wick is the supply zone, price shifts down, and that zone, it shifts down to where the supply, the liquidity that it pulls from, is no longer up here. It is this area right here. Now, it won't always be obvious when a zone shift happens, and it's fine if you don't want to take those trades, because the risk reward can be a little bit off because you're moving your entry lower, especially if you want to keep your invalidation at the actual high. So in those instances, I will usually take my entry at the midpoint of that zone just to make the risk reward a little bit better, and I'll keep the invalidation above that zone. If it does work out, I'll keep it at the high, the true invalidation level. But to each your own, whatever works for you. I just wanted to point this out because zone shifts are very common, and you want to be prepared for it, because you can miss a lot of trades if you aren't aware of this reality. So price came down, made a low, retraced into this new zone. The zone shifted from here down to here with this consolidation and this huge impulse to follow. It retraced into the midpoint area almost perfectly, and then made a new low. All right, now let's transition to another crucial aspect of any trading strategy, and that's stop losses and price targets. So one thing every trader always needs to focus on is having a very clear and precise invalidation level. If you have very up in the air or flexible levels, it'll be hard to commit to a trade being bad, when it's actually invalidated, when to exit. So you want to have a clear level. If price trades there, you're out. Your trade idea is wrong. It's been invalidated. You want to have very clear levels of when to get out and also when to take profits. If the more clear your take profits and price targets are, the more reliable your trades will be, the easier it will be on your psychology, honestly, because you won't be vacillating back and forth, whether or not the trade is bad or good, or whether or not you should get out. There is a clear level where you exit. And you also need clear and realistic price targets. A lot of people, they'll just throw their take profit up wherever they want. They're like, I want a 30 risk to reward trade. Cool. That's not how it works. You need to have a realistic price target that is consistent with structure. So I've had a lot of trades I've showed, or pictures of trades I've showed, where you target the previous high or the previous low. Because if you are consistent with structure, if price is to continue in a way that is consistent with structure, you are going to make a new high or a new low. So that is the most obvious take profit level. You can go further, but you never know how far price will trade above or below that high or low. So that is just the best reference to use. Now, it's not the only reference to use, but you just want to be realistic. It's not just about throwing your take profit as far as you can, because that doesn't mean price is going to go there. You need to pick some place where price realistically will trade to. And that all plays into this final point of having a sustainable risk to reward ratio. Because just because you outline a clear invalidation level and a realistic price target doesn't mean the trade is worth taking. You need to make sure that the risk to reward makes sense. And that could depend on your win rate, because different win rates require different risk to rewards to be profitable in the long run. But ideally, I like to shoot for at least a 3 or a 1 to 3 risk to reward, so a 3R trade. I find that to be more sustainable. If I see something that's a 1 to 2 risk to reward, a 2R trade, I usually don't take it, because that isn't enough to excite me. I don't think that is sustainable in the long run. I would prefer to have higher risk to reward trades. So even if I've identified a clear and precise invalidation level and a realistic price target, if based off of those levels I've outlined, my risk to reward is 1, 1.5, or 2, I won't take it. I don't care how good the trade looks or feels or whatever it is. I need to have a sustainable risk to reward to entice me and encourage me to take a trade. So here is an example of another, in this case, demand zone trade. So we have this low, here's the zone, huge impulse, make a high, price comes back into that zone, entry at the top, invalidation at the bottom, and targeting that previous high, like I've talked about, gives a perfect 3 risk to reward. And that is why I would take this trade. Now, if this high was a little bit lower, I may not take the trade because it wouldn't be 3, even though the idea is still the same, because I want trades that give me the risk to reward I want. You don't have to take any trade. You only, is the beauty of trading, you only take the trades you want to take. You don't have to take anything that doesn't scream profitable or likely or whatever. You get to be picky, and that's the beauty. So you take the trades that give you the risk to reward you demand. All right, so here's another one. So we have this high right up here that led to a low, this being the supply zone. You can kind of see this order block based off of this green candle to the high. And then this impulse down, we retrace into it. Entry at the bottom of the zone, invalidation right above the high, because that's consistent with structure, and then target all the way down to the previous low. And that gives a 5.5 risk to reward, a 5.5R trade. I'll take that every time. And here's one more example. So we have this high right here. This is kind of a range zone. So again, pointing out to the flexibility of how you draw your zones. It's not always clear what you should do. I'll actually usually base it off of what my risk to reward might be. So we have this zone with this impulse that led to this low, and then we retrace. Now, the reason I might be more willing, in this case was willing, to have it based off the range low, not the range low, but the zone was based off of a range rather than an order block or a particular candle, was because based off of the invalidation level of this high and having the entry right here, the take profit at the previous low, the trade was still a 3R trade. Now, if this was a 2.5 or a 2R, I would probably move my entry to be more in line with something like an order block or a particular candle, because I won't take it if it's 2.5. So that can be one of the reasons that motivates you to use a range or an order block versus a candle body approach. If the risk to reward is appropriate, why not take the more likely entry? Because you're risking a fair amount, or I should say an appropriate amount, not too much relative to where your realistic take profit is. So in that instance, I was more willing to base this trade off of the range rather than an order block. And then here's an example if you don't have a good risk to reward based off of where the previous high was. So you have this zone, this impulse, you make a high, you retrace, and if you based your take profit off of that previous high, this just wouldn't be a worthwhile trade. It'd be maybe like a 2R trade, if that. And that, in my opinion, is not sustainable. It's not worth it. So in those instances, there's two ways you can do it. You could do it the way it's outlined in this picture, which is actually not my ideal way of doing it, ironically. And you have your entry, your invalidation level at the same spots, just below this low, and your entry at the top of the zone. And then you just push your take profit to a 3R trade. I usually don't go higher than that because that is my minimum. And if I don't have any levels that I'm basing it off of from previous price action, I just stop it as soon as it gets to 3. And in this case, it worked out. But the second way that I'm going to say right now, I would actually prefer. So I would have my take profit at this previous high, the stop loss at the same level, because you don't want to sacrifice your stop loss, because that is based off of a very clear and precise invalidation level. If you move it up here and price goes down, you could get stopped out of a trade that is still valid. So I don't recommend tightening your stop loss into a level that would technically include valid trades. So you leave the stop, you move the take profit down, and then you just move your entry until you get to that 3R trade. And in this case, it actually probably would have worked out. You could have moved your entry probably down to this level right here with the stop the same, take profit here, and that probably would have been about a 3R trade. And based off of this wick, you probably would have got in. So that is what I would recommend. But either of them work. This one is a little bit more kind of up in the air. Let's just throw the take profit wherever. But that's why I would only stop. I would stop at 3. I wouldn't keep going just because that's my minimum. And if I don't have anything to base off of, I'm just going to do it on my minimum required risk to reward. But I would recommend doing the lower entry more than just raising your take profit, because this is still in the zone. You keep your invalidation level the same, and you could still get the entry. If you miss it, so be it, but you're still maintaining a good risk to reward based off of actual levels like this previous high and this low. So your trade is still consistent with the structure. You're just lowering your entry to make your risk to reward appropriate for your trades, for what you want out of your trades. All right, so let's recap a little bit. So we start off with identifying and drawing all the supply and demand zones. You go through price, you find your zones, you map them out, and then you look to identify the lower time frame and higher time frame structure. It might depend on your personal trading strategy. If you trade like 5-minute charts, obviously a higher time frame matters less, but I still think both are important for context to establish an overall bias. And sometimes they're at odds with each other. Lower time frame structure might be bullish, while higher time frame structure is bearish. But that's still something you want to keep in mind. Again, it depends on your preferred time frame that you trade, but I would still try to identify both. And once you identify structure, you ask yourself, if it were to continue, say it's in a structural uptrend, if it were to continue, where would the demand zone be, or where would it react to? What demand zone would it react to that would be consistent with that structure? So if that structure were to continue, what demand zone or supply zone would it likely play off of. So you identify and draw your zones. You identify the structure and establish a bias, and then you look at where your zones are and ask yourself, if that structure were to continue, where would price react? Would it be this demand zone, this supply zone? Doesn't really matter. You just identify it, and those are the levels that you will be focused on the most. Once you find the demand and supply zones that are consistent with structure, you can then outline your stop losses, price targets, and workable risk to rewards. Again, workable. You want to make sure you're taking good risk to reward trades. All right, now let's transition to another very important element of trading in general, and that is confluences. Now, there are a lot of confluences you can use, a lot of indicators, whatever you want to call it. I'm only going to be focusing on these 5 right here, but like I said, there's tons that you can do, EMAs being one of the ones I left out that a lot of people like. I personally don't really use them that much, and that's why I left them out, but they can still be a really good confluence to look into. So this is not the be-all, end-all list of confluences, but maybe I should just mention real quick what the hell a confluence is, and it's basically just a additional confidence builder. It adds to your conviction in a trade. It's not a reason to trade in and of itself, but it can add confidence to your trade idea. And let's start off with this first one, premium and discount. So this one's pretty intuitive, and as the name would, it's pretty self-explanatory, to be honest. So you establish some sort of range, some price range, right? We have this low, range high, and here is the midpoint. So when price is trading above that midpoint, it is trading in premium. When it's trading below that midpoint, it's trading at discount. And as a general rule, again, this is not a absolute rule. You can break it as you see fit. It's up to you. It's just a confluence. But as a general rule, when price is trading in premium, you don't want to take buys. You want to be looking for sells, because there's a higher probability chance that it goes down when it's trading in premium territory, hence taking sells rather than buys. And the same applies to the discount territory. If price were trading below in discount, you don't want to be taking sells, because there's a higher chance that it trades up into the higher end of the range. So again, pretty self-explanatory, pretty simple, easy to identify and use as a confluence in any of your trades. So keep that in mind, premium and discount. Another important confluence is retest when it comes to supply and demand zones, although this can undoubtedly apply to a lot of other types of trades. But again, this one is mostly self-explanatory. You have this supply zone right here, strong impulse. You can call this potentially a break of structure, but a strong impulse down, come back into that zone, drop back. So you see there is some selling pressure in and a reaction to the zone. You come back in, retest, make a lower low off of that first reaction, and then one more retest. Now, you can choose to enter on the first retest or the second or even a third. The more retests you do, the less likely you're going to actually get a chance for that entry. I found second retests are probably the best balance of confidence and likelihood, because the third one is a little bit more rare, so you really won't be getting nearly as many trades. But you just want to see that price is reacting to these zones. And now oftentimes you see just one reaction and then it keeps going, and so you never get that retest. But if you do see a retest, that is a confluence that can add to your conviction that the trade is a good idea. So you see this reaction, come back down, and one more reaction. Now this stop is a little bit generous, but the entry would just be at the bottom, and your stop could just be right here above this previous high. Target at the range low, sell side liquidity, whatever it is. But you're just looking for this retest of the zone that shows liquidity, selling pressure is here, and every retest you see is just adding to your conviction. And here's another example of a retest. So here is the supply zone right here. Strong impulse down, some consolidation. We come back in to retest that zone, drop out, and we make a lower high. Now that is a good sign. I love to see that when we have a reaction to a zone. You have this is a high, a low, and a lower high also reacting to that zone. We see a reaction right there. That's when I would be looking to enter my trade right here. As soon as I saw this reaction making a lower high, based off of this lower high from here, coming back in, you put your entry right here, and you could even have your stop. I mean, this is the real invalidation level above this high, but you could have it just above this one if you're confident that this lower structure will continue. It did break above this one, but it did not break above this high. And this is the high I probably would have based my stop off of. Realistically, you can have it more generous just because you have room. When you do have room, based off your risk to reward, to have a looser stop, sometimes it's better just to make sure you have some breathing room. I wouldn't get too out of hand because you want to take advantage of high risk to reward trades, but you just keep that in mind. If you have like a 5 or 6R trade, you can be more generous with your stop loss. You don't want to get wicked out on something even though the trade would have been good. So if you have breathing room, sometimes it is smart to use it. But yeah, anyway, moral of the story, we see this test, weakness, reaction or second retest, and a strong reaction. You got a stronger candle, lower high, final retest where you can have real conviction because this is your confluence, these retests. Enter here, stop here, take profit at the demand zone or range low or wherever. But that is adding to your conviction. You're seeing these retests, you're seeing reactions to price, you're seeing that selling pressure enter the market, and you enter on that retest. All right, another confluence I like to look for, I call it a liquidity line. So you have this demand zone right here, right? This demand zone, this impulse that led to this high, and we retrace, and we show some support around this level. It's not perfect, but it's pretty close, where price is reacting to this level, this support level, and we come back down, and we break this support level and dip perfectly into this demand zone. Now, why is this a confluence? Because you have a ton of sell-side liquidity that is built up in this area right here because of this support. These relatively equal lows that create a bunch of sell-side liquidity right here with stop losses. And so price just has to dip in there to grab those, and it also dips into this demand zone. So there's two kind of reasons liquidity is entering the market, and that is the confluence. It's not just that there is this demand zone that you could play off of just because it is a good demand zone, but you also have this liquidity line where you can see price dipping through to grab that liquidity to run these stops, pull liquidity from running those stops in addition to grabbing liquidity from this demand zone and continuing higher. And the next confluence is volume. A lot of traders like to use volume. This isn't a traditional volume indicator. I prefer to use the volume flow index. It's basically the same thing. It functions the same way, kind of like a MACD to be honest. But here you can see we have this demand zone that led to this high. At the same time, we see the volume going from red to green. That lines up with making this new high. And so what that does, it gives you conviction that this demand zone is more likely to see a reaction because the volume trend, the bulls are taking over. The volume trend is shifting. We are going from red to green around the same time this demand zone is formed. So we see this high. We see the volume changing. That is a confluence, adds to our conviction that this level will see a reaction to the upside. So we enter here, invalidation at the low, target the high, and I'm pretty sure this is about a 3R trade as well. Maybe a little bit more, maybe a little less, hard to say. But this is the confluence. We see this shift from red to green. At the same time, this demand zone is being formed, leading to a high, and it lines up very nicely with price retracing into that level while the volume is shifting higher. And the last confluence I'm going to touch on is Fibonacci. Very popular. I don't use fibs that much, but I do sometimes, enough to warrant me including it in this video. And this is pretty simple. So like with anything, there's really no rules. You can use whatever levels of a fib work for you. But generally speaking, people like to use these levels right here, from the 6.1 to the 70. It kind of offers a little bit of a zone. And in this case, you start the fib at this high, and you stop it at this low. And this 61.8, 70 level lines up almost perfectly with this supply zone. This is kind of like a zone shift, so you could base it off of this. But based off of this price action, this seemed like an appropriate zone shift where price would pull liquidity from rather than going all the way up here. So again, you got to be kind of attuned to when zone shifts might be happening. Not always reliable. Sometimes price still breaks through and eventually goes to the higher supply zone. But these zone shifts are real. As you can see, this is a legitimate reaction to that zone shift. But even say you were up in the air about whether or not that zone shift is a zone shift, whether or not you want to take a trade off of it, you pull out this fib and you see that it lines up very, very nicely, almost perfectly with this 61.870 level. So that can be your confluence. You're like, okay, I'm willing to take a trade off of this because this zone shift lines up perfectly with these fib levels that are often consistent with a retracement and bounce, or I guess downtrend. Okay, so let's summarize what we've learned so far. Now, you start off, obviously, with drawing your supply and demand zones. And again, you can use candle bodies, wick to wick, order blocks, ranges, combination of all of them, or just 2, 3, whatever works for you. Understand that there is no one shoe fits all. It really depends on context, and sometimes they apply at different times. You can use them in accordance with your risk to reward, whichever one lines up better. It really is subjective. It just depends on the situation. So I encourage everyone to experiment with both and consider all of them because they can apply at different times or be useful in different circumstances. But once you draw your supply and demand zones, you then need to identify structure and the overall direction of price. Structure is huge. It's important. It makes supply and demand zones valid. Supply and demand zones don't necessarily matter out of context to structure. They need to be consistent with the overall trend and structure. So once you identify your supply and demand zones, you want to look at structure and see which of those supply and demand zones are consistent with that structure. If it were to continue, which zones would it react off of? And after you figure out those, you identify the best supply and demand zones that are consistent with structure. You can then outline your stop losses and take profits, your realistic ones, your clear and precise stop losses, and a realistic take profit that leave you with a workable and sustainable risk to reward. Always keep your risk to reward in mind because it's important. It can depend on your win rate. So if you know your win rate, you will know what your risk to reward needs to be. But either way, I encourage everyone to shoot for at least a 3R, 1 to 3 risk to reward. So you draw your zones, you identify the structure, the zones that work with it, you outline your stop losses, take profits, and a workable risk to reward, and then you look for any confluences to add to your conviction. Like I said, there are a number of confluences you can look to. I just touched on a few of them, some of my favorite, the ones that I like to use the most, but really anything's fair game. Use whatever confluences work for you, but just keep structure top of mind because it is the most important. All right, well, that's all I have for you today. I hope you learned something. I hope you're able to apply this to your own trading successfully. And with that, I'll leave you with stay happy, humble, and most importantly, solvent.